Welcome everyone this evening to a wonderful webinar organized by Dr. Nick Verma on looking at different aspects of private and academic practice acquisition and expansion. This is a topic that's in the foremost minds of shoulder and elbow surgeons and orthopedic surgeons. And Dr. Verma really has done a wonderful job of organizing a wonderful program for us tonight. And with that, I will turn it over to Nick.
Thanks very much, John. So first of all, welcome everyone. We're encouraged that you were able to attend. This has really been a hot topic in orthopedics over the last 2 years. It's kind of been the buzzword throughout all of the meetings that we all attend, and that is to discuss equity opportunities in orthopedics. And we've assembled what I think is an amazing group of individuals with a lot of expertise in this area to share some of their thoughts about the different ways this can be handled and how it's beneficial for your practice. We have Don Edwards. Don is the founder and CEO of FlexPoint Forward Capital. They're a Chicago-based private equity firm that has a specific interest in the healthcare field. Michael Bannon is with CSG Partners. He's a VP, and CSG is essentially a consulting firm that works in the ESOP space. And Michael talked to us about how the ESOP is a specific tax-efficient vehicle that can be used for companies, including healthcare companies, to try to establish some equity interest or value in their practice. And finally, Brian Cole. Brian's my partner and also the managing partner of Midwest Orthopedics at Rush. Under Brian's direction, we now have over 160 million in top line revenues, and we've recently been able to execute a merger with another large orthopedic group in Illinois to make us the second largest musculoskeletal provider in Illinois. And Brian will talk about some of the strategies that you can use if you decide to go it alone with potentially a healthcare partner or partnering with other groups in your area. So I just wanted to set the stage here a little bit. I think we all understand that there's been some drastic changes in healthcare after the last 2 decades. It really started with the Obama administration and the passage of Obamacare. And really the buzzwords here are, how do we bend the cost curve? And the reality is that as a developed nation, we spend more on healthcare than any other developed nation in the world, and it's just not sustainable over time. So what you hear people talking about is can we somehow bend the curve? Can we start to decrease the rate of incline of the amount of spending on total U.S. healthcare on an annual basis to make this more sustainable going forward? And as a result, this has put some downward pressures on the physician side. We've seen declining reimbursement. We have payer mix challenges with more and more payers moving to government systems such as Medicare and Medicaid, which are hard to be profitable on, narrow networks where we're having trouble having patients access our care because they may be confined to a very specific network in an attempt to lower cost. And we've seen that much of the cost of a healthcare episode may be shifting towards the consumer, which is the patient, which means that consumers are looking more and more closely about where they obtain their healthcare and potentially the quality associated with such. We've also seen this change to maybe not paying us based on how much we're doing, how many procedures we're doing, or how many patients we're seeing in a given day, but trying to reimburse healthcare entities, including physicians, based on the value of the care they deliver. So it's not, did you do a shoulder replacement, but it's how did that shoulder replacement do? And was there a complication associated with that that may be determining your reimbursement in the future? It certainly sounds good to talk about on paper. It's becoming increasingly clear that this is very difficult to execute on in the real world environment. We have seen, however, that we're moving more and more towards alternate payment models. And this can be as simple as just being required to report your outcomes over time, things like reoperations and hospitalizations, complications. On a basic level, it can be an episode of care where we bundle together things like the facility fee, the anesthesia fee, and the surgical professional fee into a single payment. There has been risk sharing, as they called it, which is bundling payments with some type of warranty, typically over 90 days. In my opinion, this is more of a risk transfer to the physician from the insurance company. And then now we have population health, which is really represented by Medicare Advantage. And Medicare Advantage is being proposed by Humana and United Healthcare. And it's actually now more than 50% or about 50% of Medicare services provided in 2022. And Medicare Advantage is simply where they provide a private company such as United Healthcare or Humana a single rate to manage each patient. So they pay you a single fee for an annual management of that patient over time, and that fee may vary based on the complexity of the patient or how sick they are. From my viewpoint, it's really hard for me to determine how this looks and feels any different than what we went through with the whole HMO craze. Maybe one of our panelists can help me understand how this is going to work any differently in the future. But the reality is we have to be prepared for these different types of payment situations going forward. Now, the good news is that the orthopedic practice model is really set up well for some of these bundled care initiatives and episode of care initiatives because we have a lot of verticals that surround us. These include things like physical therapy, imaging, DME, sports performance, infusion therapy, and of course the ASC, which is integral to the practice of orthopedic surgery and shoulder surgery, elbow surgery that we all do. And I think there are a couple of reasons why this is really important for you to understand in your practice. Number one is we can do this with better quality and lower cost than the hospital and the health system all day long. We're just more efficient. We're better when we're in a concentrated space. Our quality gets better and our complication rates are lower. Number two is if we have access to all of these verticals, we control the bundle, which means that we can determine how much we're going to charge for the episode of care and how much we want to allocate to the professional fee, the facility fee, maybe the rehab afterwards, and reinsuring our risk versus somebody coming to us and saying, this is how much we're going to pay you for the professional fee. We're not telling you what we're getting paid for the entire bundle, but the rest of it goes into our pockets. Number three is, as we've already talked about, there's downward reimbursement trends, which is putting downward pressure on physician compensation. And these are opportunities for alternative revenue from different service lines can help us to improve our compensation. And then finally, by developing all of these verticals, we're developing value for our members. Think about all of the different PT companies that have gone either in private equity or some of them even publicly listed that have generated millions of dollars for their founders on the backs of our referrals. And so why should we not be able to participate in that game as well? So how do you stay competitive? I think you need to get bigger. You have to be too big to fail. You have to be having leverage in your market, which can be either local or regional. But the problem with that is it's difficult to do. It increases your overhead. It increases your complexity, as we'll talk about. You have to control your own verticals. We mentioned on the last slide, and I think that's critical to survivorship of an independent orthopedic practice. You've got to be able to play in the outcomes reporting space. And more, particularly if you're going to take on risk, you have to be able to accumulate the data to be able to perform the analytics to identify when that makes sense for you. So how do you grow? Number one, you need a strategic plan. What are you going to do and how are you going to get there? Number two is you need the leadership and expertise. And the reality is that most private practices have a very antiquated model of governance. That is one partner, one vote. And I can tell you from experience, when you get bigger and bigger and you're trying to get all of the partners to agree on a specific strategy or a specific decision-making, it becomes very complicated and it's not scalable. On the structure side, you have to make sure that you're compliant. You have to think about your distribution models as you start to develop these service lines. And how are you going to develop future value for the partners who are investing in the growth of the entity? And then finally, what is your goal in the future? Bigger is not always better. There's more risk, there's more overhead, there's more headaches. So really, what's in it for me? And then finally, if you are going to grow and grow relatively quickly, you need capital. And that's where some of the gentlemen on this call may help us to understand some strategies to do that. The challenges are that most practices are full distribution, which means whatever we take in gets paid in overhead and the remainder gets distributed to the partners. And so the practices essentially have zero value. As I talked about, there's antiquated leadership structures that are really hard to manage as you grow and want to scale structure. Physicians are at different stages of their career. So younger physicians have different priorities than mid-career physicians have different priorities than physicians ending or nearing the end of their career. Inherently, physicians have fear of competition. We all see this, right? We're going to say, okay, we're going to put a new practice out in the suburbs. We need to hire a new shoulder surgeon. And all of a sudden, everybody's saying, wait a minute, we've got too many shoulder surgeons. There's not going to be enough business for me. And then finally, the reality is what's in it for me itself, because you grow doesn't mean that your individual day-to-day compensation is going to get higher. So what's the end game here unless you're going to somehow generate equity value from the growth that you achieve over a career? The challenges are, as we talked about, bigger doesn't mean better, and bigger does not mean more compensation for the individual physician. So you can look at our group at 50. The Grothman group is probably over 200 at this point. And I would venture to guess that the independent physician compensation between each of those groups doesn't change much. There might be more value in the organization, but until you tap into that value, there may not be any actual upside for the individual physicians. There's income reduction. So if you're going to reinvest into the practice, you've got to have a way to generate some capital for investment. And that often means that physicians are taking home less. There are regulatory concerns, and those can generally be navigated. And again, what are you trying to accomplish here? And how do you actually extract that value that you're going to generate over time? Capital sources is going to be a main aspect of what we're going to talk about today. The basics are that if you want to generate some capital, you've got to retain earnings. As I talked about, most physician practices or private practices are pass-through entities. So you've got to say of every $100,000 that we earn, we're going to hold back $10,000 for future investment. When you can do that, you can then go to a traditional bank and leverage that to get 2 to 3 times what you're holding back in some form of a loan. You can go to a private credit market, which is essentially where you'll get a couple more turns on that holdback. So instead of getting a 2x or a 3x leverage, you'll be able to get a 4x or a 5x leverage, but you'll do that with a higher interest rate. And then finally, you can go to an equity partner or a strategic partner or an ESOP model, as we'll hear about, to really extract some equity value from your practice, but also to create some leverage in order to invest and grow in the future. So with that, I think we're going to turn it over to our speakers, and that just kind of sets the table. And the first is Don Edwards, and Don's going to share with us some high-level thoughts on how private equity can help the orthopedic space.
Okay. Thanks, Nick, and it's a pleasure to be with you all here today. I've known Brian and Nick at MOR for a long time, and they're good friends, and I admire what they've done just tremendously. And so I'm excited to be able to talk to this group about the opportunity that orthopedic practices have with private equity. I'm going to try to share my screen here and see if I can make this work. Share. Okay, now I've got to see if I can get that to the beginning of my presentation. This is always hard. Here we go. Okay. There we go. Okay. Technology is very challenging for older people like me. Can you guys hear me?
Yep, we got you.
Yeah, you're good, Don. No problem.
Okay, you can see the screen?
Yep, all good.
Okay, perfect. All right, so the first thing I'm going to do is just give you a very, very brief introduction as to who I am and who you're listening to here. I founded our firm, FlexPoint Forward, almost 20 years ago now. As you can see from the chart here, we have $8 billion of private equity under management. We're on our 4th fund, just closing our 5th fund, which is a $2 billion private equity fund. We operate in Chicago and New York. We specialize in only 2 highly regulated parts of the economy. Healthcare is one of them. Financial services is another. I'm going to go to the next page here. And this is a history of our principals investing in healthcare. And as you can see from this chart, we are almost specialists in healthcare services writ large, not necessarily physician practices, but you can see from this, we've been in all kinds of different kinds of hospitals, surgery centers, clinical laboratories, behavioral health, dental practice management, et cetera. And in that, we've had a couple investments in physician practice management, including the most recent one here on the chart, which is in 2017 in Southeast Eye Specialist, which is in Tennessee-based ophthalmology practice. But anyway, the important part about this chart, and I'll get into it later, is as you choose your capital partner, someone who has experience working in government reimbursed, physician-centric businesses, I think is a very important component of choosing a capital partner. The other thing I just might add about our firm that is a little unique and something to check into as you look at various private equity firms you might partner with is who are their investors. We happen to be largely funded by endowments and foundations, a lot of universities, a lot of people who have an interest in healthcare in the United States. And so that's a little bit about our firm, and we've been fortunate to generate, 20% returns on average for almost 20 years now for our limited partners. And as I mentioned, many of them are places you guys work with, such as Northwestern Hospital, Northwestern University here in Chicago, and Stanford and Yale and places like that. So people that have an interest in healthcare. So I'm going to try to cover some high level components of what it means to partner with private equity. What are some of the advantages? What are potentially some of the challenges? And most importantly, Nick has hit on a lot of things here. Like, is it better? How does it work? Is it better to partner with private equity and acquire other practices? Do you really end up with, candidly, more money at the end of the day, more satisfaction? Is it a better way to go for the orthopedic practices of today? Here you can see some of what we consider to be the benefits of investing with having a private equity firm invest in your practice. And I'm going to actually touch on these in a little bit more detail here in a second. In terms of just really, really basics, yes, we raise money from institutional investors. Yes, we have $8 billion under management, but what is private equity versus venture capital, and what kind of partner do you want? On this chart, we just sort of lay out the continuum of private investors in private companies. Venture capital is going to be funding things in healthcare that are not orthopedic practices. It's going to be funding new technologies. It's going to be funding new software products. It's going to be funding new products, et cetera. Sort of the next level of fund in our community of investors is what we call growth equity, which is going to be funding many of the companies I just referred to in the venture stage, but maybe after they've reached either close to profitability or nearing that, but they have momentum, their products are validated, they're not what we would call ventures. And then traditional private equity, which is investing in companies that already have cash flow, that are already relatively established. The risk is not in, is the product going to work or be needed or execute? It's in, can you grow the business? And that's where FlexPoint operates, and that's where most investors in physician practices operate, in that part of the spectrum. I would say, though, that there's a component of growth equity within investing in physician practices as well, where you have to take some risk of opening new facilities, investing in new equipment, in order to really get the advantages of creating a physician practice company that can grow and succeed in the new world. So in a certain sense, I would say we operate in the healthcare services world, especially in physician practices, sort of one component of growth equity and one component of traditional private equity investing in more companies. So that's kind of where we would fit on the spectrum and where you would want us to fit. Here is that chart I sort of referenced earlier that we would talk about in a little bit more detail. These are what I would say are the potential benefits of private equity. As Nick talked about, how do you succeed in the new world? You absolutely have to get bigger. You absolutely have to have scale in negotiating with your payment partners, whether they be insurance companies or the PPOs of the world, or whether it's even dealing with Medicare and Medicaid. Having scale and having the ability to invest in the technologies necessary to manage that scale, I think, is critically important, as Nick said. So the opportunity to help you grow and accelerate that growth with capital, I think, is something that we can bring to the table. As you create this larger company, as Nick said, at some point you have to go from a partnership model where you pay out all of the earnings to a company model where you retain some of the earnings. And if you do that, as Nick said, you can then sell some of that retained earnings to someone like us, a FlexPoint or another private equity partner, for value. And we're going to get into that. And that's beginning to answer the question of, can I end up with more earnings, more money at the end of the day from partnering with private equity? And that access to capital that we bring is very, very important to supplement that acceleration of growth through acquisitions. I would tell you that Brian is going to talk to you about going in alone and creating value, without a capital partner or merging with other entities. And MOR has been incredibly successful at doing that. It's actually the rare practice that can pull that off on their own without a private equity firm to help them with their capital needs along the way. MOR is there, they're over the hump. But that being said, to capitalize on that value in selling a portion of the company and then growing it more and then maybe going public or selling to a larger strategic down the road, to get all that done, the sooner you partner with a private equity firm, probably the better. And that gets to the bottom piece of this is if you have a capital partner, a financial service expert helping you do this along the way, preparing your company for that next sale, that is how you can turn what Nick was talking about, becoming bigger, creating retained earnings. That is how you can capitalize on that and create what's called a liquidity event or a sale of those, effectively those retained earnings to the marketplace. And that's how you can ultimately end up, candidly, with more money. And we'll get into a specific example of how that works. One of the things for you guys to consider if you are looking for, these are some of the things to consider if you are thinking about a private equity partner, is there are very different kinds of private equity firms. And one of the things I would emphasize before we get into the economics of a transaction is it's very, very important to pick a financial partner, a private equity partner that matches the vision and culture of your firm. You can't fix that later. It's very important that that be set up, at the time of transaction, because this is your now governance partner. Nick was talking about governance. It's hard to govern a partnership with 20 equal partners. It's, when you bring in a private equity firm, you have to do that. Plus you have to share governance with the private equity firm. So it doesn't necessarily make things easier. It does allow for leadership to create a board of directors that can control the company in a perhaps easier way than a true partnership model. So there are some advantages to setting up a governance system where it's, perhaps 51% or 50% owned by the private equity firm and 50% owned by the physicians, because it does create this partnership that now governs the whole company, if you will. I do think that in addition to being able to create retained earnings and sell them on the front end, private equity firms, contrary to some popular belief, are looking to invest more. They are looking for organic growth opportunities in the companies they invest with. And so if we were to invest in a orthopedic practice, we would be, digging in with the physician partners and leadership on exactly what opportunities are there in ancillaries, in building out more surgery centers, in physical therapy, and whatever investment opportunities there are in those, we would want to help fund. And so it takes away a little bit of the concern about how do I create, investment capital to take advantage of these opportunities. And so these are some of the things to consider. And lastly, I would say, we'll get to it, the compensation model going forward is going to be very, very important. And I know that everyone's working on their compensation models. When you bring in private equity, you're going to have to get it to a sophisticated level, even beyond what you're doing now. Quickly on how do you create value when you have a private equity partner? As you can see from this chart, you have practice today, you have your level of profitability. Obviously, you're hoping to grow your volume. You can hire new physicians and grow in that way. You can, as Nick talked about, increase capture of ancillary revenue. And I would tell you that third piece is absolutely critical to creating equity value that you want to sell. And so all three of those can be done sort of without a private equity partner. They require commitment from the physicians, as Brian can talk about. They require commitment from the physicians to invest, to maybe leave some earnings in the company, to take on some debt, to build out these ancillaries. It's very valuable if you do it. So I highly recommend, whether you have a practice, a private equity partner or not, you do these three things, and especially this one here, which is what I consider to be the most efficient way to create value in your company, is to do this. But the fourth piece, the add-on acquisitions, this piece right here, this is the part that I think is the reason everyone should be considering partnering with private equity today. Because as the pressures that Nick talked about ramp up, the size and the strength in markets is going to be that much more important. And it is so much faster to get there by acquiring or merging with other practices than it is to build your way, organically. So these things I would say everyone on this call should be doing with their practices all the time. This fourth one of add-on acquisitions, that is probably the number one reason to bring a private equity partner into the mix to get you to this bar here of future profitability. So let's talk about, in our limited remaining time, what does a private equity transaction actually look like, and how do I get there? If you have a practice like Nick was talking about, where you pay out all of the earnings to the physician every year, well, if there are no bottom line earnings or retained earnings, as Nick said, then there's nothing to sort of sell to a private equity firm, and there's nothing for them to value to buy. So how do you create on the front end, if you haven't done it already, a bottom line for an investor to come in and buy into? And as you can see on this page, practices are valued based on what we call EBITDA, which is profitability before taxes and interest. So just think of it as profitability of my practice before interest and taxes. Well, if that number is zero, then you can't sell to a private equity firm, because we have no cash flow to buy. So the way that you have to set up the business to bring in a private equity firm is for compensation to be sort of reduced on the front end. And then you create an annual amount of retained earnings, and then you can sell those retained earnings, or the ability to access those earnings, to an investor for a very, very, what I would consider, good deal or high value for the physicians. So the first thing you have to do is create a company with earnings, and that does involve what some people refer to as a scrape, or reducing current earnings in order to have net income or EBITDA to sell to an investor. Now, doing that, it could be good or could be bad. If you're getting a high enough, what we call multiple on that scraped earnings, it could be very, very good, and that's what I would focus on for the coming part of the presentation. Key economic considerations for this compensation adjustment are: what's the time value of money? If I'm getting a big payment up front in exchange for reducing my earnings, that has value. If I'm getting a big payment up front on an exchange for a portion of my reduced earnings, I can invest that in other diversified things. So I'm a little bit more diversified as a person, as an investor in my life, which I think is very important. We talked about what private equity can bring as the industry changes, and there's some stability that having a capital partner brings. And then there are significant tax advantages to actually scraping your income, and I'll touch on it at the end, turning ordinary income into capital gains. So I got to get through this last piece really quickly so that we stay on time. And it's how do you actually affect the first transaction before you would then acquire more practices and go public. And what this example on page 12 of the presentation here is: if you have a practice with revenue of 50 million and expenses of 30, and the partners take home 20, what we would then do to create a company that you could sell to a private equity firm is we would have to reduce, as you can see over here, compensation by, let's call it 25%, 20 to 30 is the normal range. And you would then create a bottom line of $5 million that is annual cash flow that could be sold to investors. And so if you go to my next page, this is how what we call the first bite transaction works. Is on the left is what I just described. You create $5 million of income. And in this example, and this is where the rubber meets the road on creating value for physicians. In this example, you would sell that $5 million of earnings for 12 times to the private equity investor, or $60 million. And then if you had a little bit of debt in this example, we're saying, assuming there's a little bit of debt, you would have 55 million of proceeds to the physicians. And then typically you would roll over a portion. In this example, we said 30% into the new company for an equity ownership in the new company. On the right side of this scale over here, we've boiled it down to what that would mean for one physician who is fortunate enough to earn $1 million a year. If they cut their compensation by 25%, that would be $250,000. They would then sell that for 12 times. That would be $3 million. And after their rollover of $825,000 into the new equity, they would take home, have pre-tax proceeds of almost $2 million on this first, what we call first private equity transaction. I'm going to skip this page because I want to get to the final part of the discussion here from my standpoint, which is if you are able to sell your scraped income at 12 times, there is, yes, you have reduced your income, but you've just gotten $2 million on a pre-tax basis. That income is then taxed at capital gains, not ordinary income. And so when you actually look at the after-tax proceeds that you would receive on this 12-time sale of your $250,000, it would equate to almost 16 times your after-tax proceeds on that $250,000, because you actually are turning ordinary income into capital gains through this transaction. And this is a key component of value creation for physicians in the first bite transaction. And this is the math of that right here on the next page. You actually increase your multiple from 12 to 16 times on an after-tax basis because you're getting taxed at a much lower level on the sale of your earnings. Finally, listen, the last thing I want to say is you do this first bite transaction to A, get proceeds on your income and capitalize them, but then B, do all the things we talked about earlier. Bring in capital that will help you acquire other practices and grow so that you can succeed in this new world that Nick is talking about. Lastly, on governance, I think it's very important to pick a firm that understands that medical practice and decision-making is going to stay with the physicians, and the private equity role in governance is going to be help recruit and oversee management, make financing decisions, capital market decisions, help with acquisitions, and then help with the exit or what we call the second bite transaction as well. Finally, and I know I'm sort of running out of time, I would say that this transaction that I've described could be considered wonderful by some people in their stage of their career, could be less advantageous to others. And it's very important when you make this transition that you work with your private equity partner to actually create a bespoke solution for every physician partner at every stage of career. So the actual 12 times and the actual cash to physicians in a sale will be customized to where they are in their careers and how much they want to work going forward. In other words, if you're only going to work 1 year, it's going to be a tall order for a private equity firm to pay you 12 years of upfront compensation for 1 year of scrape. On the other hand, if you're a very young physician, that might not sound like the greatest deal of all time, because if I have 30 years in front of me, it's very different. And so it's very important for fairness and for motivation going forward that it be tailored in a way that works for every physician. And it can be done that way and should be done that way. And then everyone can participate in the equity opportunity of growing the business and then selling it to either a public market or a strategic partner going forward. So I know that's a lot of stuff, but I think it's important that we stay a little bit on time. I'll be happy to answer questions when we get towards the end.
Don, thanks so much. That was a great overview of how private equity works, basically an intro 101 to private equity in healthcare. And I think the questions at the end will be really helpful. So if you can unshare, I'm going to turn it over to Brian, who's going to talk about some of the things that we've experienced at Midwest Orthopedics and ways that you can potentially at least build to a certain point by going it alone.
Okay. You can see that fine?
We're good.
Okay. So, it's interesting. I've heard a number of private equity talks over the years, and every time I listen, I learn something new. And you also learn a vocabulary. And those of you who are on this webinar or who listen to this after the fact, it's pretty compelling. And 3 years ago or 4 years ago, we, for about a year to 2 years, diligenced a private equity relationship. And we ended up going a different path. And I'm going to share with you how we got to the point we are now, so that you can understand sort of the thinking from a private independent group, and also share a little bit of the inside of what it's like to be with a relationship with Rush, a hospital, yet we maintain a private independent practice. And Don, I appreciate your comments, and I'll be interested, Don, maybe take some notes, because I'll give you a chance to sort of provide a rebuttal to some of my comments, because I'll be really interested in your thoughts. One of the things that's fascinating, and Nick alluded to this a little bit, is that we're seeing a lot of macroeconomics in healthcare that are changing what all of us do as orthopedic surgeons. And it wasn't long ago where it was about 70 to 80% of us were in private practice. And now it's somewhere between 25 and 50%. And that number is decreasing. And it has a lot to do with various so-called headwinds. That's headwinds and tailwinds are the two most commonly used words in every private equity conversation. You'll hear first bite, second bite, headwinds and tailwinds, and bespoke. Those are the 5 or 6 words that are used in every presentation. And truth be told, they're meaningful. And in this situation, we have a number of things that are sort of pushing us from the private practice model to start working for hospital-based practices. And you can see the numbers decreasing over time. So I'll share with you a little bit about who we were 4 years ago, and then share our journey. And then at the end of my presentation, I'll show you where we are now and some of the decision-making that went into putting the private equity conversation on hold, putting the ESOP conversation on hold, which will be your next talk. So our practice is about 35 years old. We are basically a very slow-growing, stable, private, independent, multi-specialty musculoskeletal group that's an LLC. 4 years ago, we had about 28 to 30 equity partners with an average age of about 50. We had about 35 MD providers in total and about 40 advanced practitioners, 500 employees. You can see a map there. We had 6 clinics, 12 physical therapy clinics, and 5 ASCs. And essentially, while we're a private independent group, we actually are the department of orthopedics at Rush University Medical Center. We are intrinsically involved in the ACGME programming for residents and fellowships, and we have 3 pillars of collaboration with Rush, which is research, philanthropy, and branding. And this relationship is somewhat unique in that we've been able to coexist and even compete. You can see the building on the top right there, where you see the reflection of Rush in the background, which I thought is somewhat symbolic and emblematic of our relationship. We have MRI, physical therapy, PTOT, DME. At one point, we even had pharmacy, all things that basically compete with a hospital directly in our backyard. I think because of that, that's led to a number of challenges and to our synergy with a hospital. And some of the things that have really, I think, moved the needle is this free market movement to the ASC environment. We're not constrained from doing so. This has led to a significant reduction in inpatient surgery, which has compromised our leverage with the hospital system. A non-for-profit hospital, their mission is not always aligned with a for-profit independent practice model. For example, the emergency room, we could choose what payer mixes we want. We don't have to take Medicaid. We don't have to take underinsured or uninsured. But that's a mission of a non-for-profit hospital. And we have to manage those discrepancies, and there's ways to do that. If we allowed a hospital system to do all of our contracting, you could see where the conflict might result, because they're not just dealing with a single specialty, they're dealing with all specialties and services provided by the hospital, not just orthopedic care, and one would have to be compromised potentially there. There's a little bit of this we versus them mentality. They have a justifiable need to reduce their dependence upon us, because as we are private independent, they actually have to maintain their sustenance. And as they see reductions in revenues from facility fees, given the outpatient shift, that puts a sense of vulnerability. We had been historically relying on the status quo, which I think what we realized 3 to 4 years ago is that was a very short-sighted view of the world. We were sitting amongst rising costs, most problematic were HR supplies, reduced in reimbursement. People talk about value-based care, but I can tell you in Illinois, it's really in its infancy, and we don't really have this inherent expertise to pursue this. Narrow networks were starting to come on the scenes. Some of the payers were saying, look, you can only operate on our patients at these surgery centers. And then they closed the door to some of us. There were a number of groups that were growing around us. So while we were growing slowly, we were actually getting smaller by comparison to the other groups around us. And we really lacked any equity model. We continue to invest in ourselves, but we really, as Don pointed out, you have to have some sort of exit strategy to create equity and monetize that equity. And we really had no vehicle to do so, despite creating increasing dividends. So we looked at our options, and we could say, look, the status quo for us has always been, when you retire, you get a set of golf clubs, a pat on the back, thank you for your service after the sometimes 30 years or more contribution to the practice. Or there are ways to sort of mitigate that and actually take a defensive and offensive position at the same time. And those are all the things you see on the right: aggregation, merger, consolidation, JV partners, practice organizations. You're going to hear about ESOPs, you'll hear about PE, and Nick alluded to some of these things. You've heard about PE. I'm going to just summarize some things that Don said, because this was really the nidus for us to go this direction under the premise that maybe there'll be a better environment for us to visit PE in the future. So as Don pointed out, PE is really a direct investment by a private company into another private company. And that you can skirt some of the excessive regulatory things that are otherwise present, for example, in a public sector. It allows you to monetize excess compensation. And that's the so-called scrape that Don talked about. And that's just a very tax efficient way, long-term capital gains, to take chips off the table. We looked at it very favorably. I mean, we like the idea of professionalizing operations. We like the idea of growth. We like the idea of being a platform. And we also like the idea of potentially having a so-called second bite over the next 3 to 7 years, where we could potentially resell at a higher valuation. So as you heard from Don, it's pretty compelling. It's a very opportunistic time, although I think it's somewhat tempered given the cost of debt and what's happening now from first bite to second bite amongst the many deals that have occurred. We looked at it, as I said, as a defensive strategy to maintain our position, and a potential to take an offensive position to bring in expertise and modernization of our practice. And, after you hear it enough times, it's kind of nice to hear that you're desirable and you can be a platform and so forth. And there's something, you think there's something very meaningful to that we basically by ourselves have not really been able to recognize and fully develop. And we felt that, look, we could build an MSO, we could build EBITDA, we could utilize that for capital for C-suite development and expansion, for more ASCs, technology platforms, EHR ancillaries, creating more verticals. We could buy more medical office space. We can consolidate our own local physician practices, and even have a potential for insurance lifts. All of these things were very exciting, and it's really the heart of the narrative when we're talking to private equity. And frankly, others seem to be doing it. Currently, there's at least 30 firms and 70 first bites that have occurred in orthopedics. But along the way, and Don alluded to this, is that there's a lot of things you have to do. And it's not just you sit back and you take your cash off the table based on enterprise value, put 2/3 in the bank, and roll over equity. You actually have to do something. And these are all the things that you'd have to do. Physician recruitment, build medical offices, look for new markets, try to create reimbursement lifts, expand technology platforms. Maybe you would be acquiring ASCs and further partnerships. And again, modernize the governance and C-suites, and even looking for peripheral novel service lines, right? Primary care, rheumatology, infusion therapy, anesthesia, urgent care. Like all of these things are verticals that go well beyond our professional revenues of seeing patients and doing surgery, which essentially just barely keeps the lights on. So if you look currently what PE is saying about PE, there seems to be a good, healthy demand for orthopedics that remains high. Supply still remains relatively low. I think there's a general prediction that M&A activity is going to continue in 2023. Interest rates are rising and multiples are falling, so expectations have to be reset. Clearly, you know, Don could talk about this in the question and answer section, but deal scrutiny is going to increase. I don't think it's going to be so easy to get these deals to pass through on the PE side. But on our side, from the orthopedic surgeon lens, it's quite infectious, and independent groups are looking at this. As I say, there's at least 30 firms and more than 70 deals that have happened to date just over the last couple of years. So overall, the surveys have been very positive if you ask the private equity folks. And, you know, I think the bottom line is, and it really depends upon the strategic partner you have, but as Lundy, who's an expert in this area, says, look, it could be good, it could be bad. It's really based on how the deal works after the acquisition. And now we're all starting to learn about what's happening in real time based upon these first bites. There's some negative though, and if you dig deep enough, you're going to find these things. And this is sort of one of those groups that basically has sort of a negative view of this, saying, look, aggressive revenue focus may be incompatible with sound healthcare. This is sort of a watchdog group. And Don, I don't know if you've ever seen this document, but I'm sure you would have a lot to say. But economists judge, you know, consolidation that leads to concentration of the markets, which maybe actually could lead to further instability. Where do the higher revenues come from? They generally come from the payers, and it isn't always associated with improvements in quality. At least in the manufacturing side, not necessarily in the healthcare side, there's some idea that the private equity can actually strip companies of their assets and may overburden them with debt. Certainly, the oversight is much less in this private sector than being in the public sector. Regulators seem to be looking at this with concerns for overconsolidation, and my guess is that we may see further challenges in this area in terms of antitrust. And now we're even seeing challenges to safe harbor, in-office answer exemptions, and so forth, that some are saying, look, this doesn't actually apply to private equity. And these are some of those headwinds, and these are the things that we really looked at and said, look, are we ready right now? Maybe we'll take a pause after almost 2 years of diligence. Even though the narrative was quite compelling. The seller, that's you and I, we pay the capital gains, and the leverage is amortized with after-tax dollars. And Don, if there's any of this that's not true, you know, you should, as I say, take some notes, and we can talk about it tonight, or we can talk about it over a glass of wine. The cost of variable, as long as you buy the wine, the cost of variable debt has increased, and the multiples have decreased. So there's kind of been a reset. PE and physician alignment remains critical, so it's important to choose the right partner. And what happens is people come in, they say, look, we're going to be a strategic partner, but you have to ask what strategy they really bring to the table. And I don't think I think what was happening is that people would come with money. That seemed to be the commodity. But arguably, I don't think every private equity group that we spoke to, and we probably spoke to at least a half a dozen to a dozen, were all could be considered strategic partners. Ultimately, the structure is going to be determined by the PE buyer. New partners there was a threat that these individuals could be difficult to hire, and existing young partners may lose interest in joining the practice with concerns about control and being left out, and exposure to overhead and economic vulnerability. And then there's this pressure to work. So that's a good thing, but that doesn't go away after transaction. That's surgical volume, that's referrals, and to encourage ancillary use. And again, the primary goal is not bite one, but bite two, that general timelines are somewhere in the 3 to 7 year timeline. And then the question, which we didn't have the answers to because there weren't any second bites to lean on in orthopedics, even though they were there in dermatology, ENT, and others, what happens next? Who decides? Is there another acquisition? Is another PE event? Is it an IPO? Is it liquidation? What happens to your culture? These are all the things that I can share with you. We were discussing behind closed doors that led to a decision to go alone. So I'm going to tell you a little bit about, what the narrative is internally when people are talking about PE, and this isn't exactly how it went down, but these are the extremes, these three buckets. You have the senior partner who basically says, look, buy me out and you'll never hear from me again. And certainly they're going to be the ones who are most interested in PE, but as was alluded to, PE should be and will be the least interested in them. And then there's the mid-level partner, this sort of 40 to 55-year-old age range where the practice is pretty mature. They have a few more years, and they're going to anticipate maybe some loss of control, but they place a premium on taking chips off the table and all the things, the pros that I talked about modernizing the governance and actually being able to do things. And they actually have to commit to that second bite to actually monetize the retained earnings. The 1/3 that gets rolled over, they really need to commit to this. And I think the most difficult group, and those of you who are junior on this call, is, look, I just became a shareholder. What are you doing? And this is the group that you really need buy-in. And this is the group that I can tell you in our group that we had the most difficulty in getting buy-in. They have to give up near-term income in exchange for ownership in a much larger entity with the expectation that it will actually work out. Second, third, other bites will happen. They're not going to feel they lost their autonomy or for the reasons they went into medicine, because most of us value our independence. And they hope that the payoff of multiple equity events in a world that may not stay the same, as long as you can get them to understand that it's not likely to stay the same. Otherwise, it's very difficult to get this group to ultimately be supportive, and it's a much more difficult conversation. So in light of all that, that's a long way of saying we decided we're going to go alone and build value because we think we can do it, and then we'll revisit these constructs. Maybe it's PE again, maybe it's the ESOP, which you're going to hear about. But we certainly felt that we didn't want to stick with the status quo. So I'll just finish up and tell you what we did in terms of the aggregation model. So we're really indebted to a group called Melvin Brothers, which has done over 50 aggregations. And this idea, I think, was first brought to us, I believe, potentially by Nick, can correct me, by the group that we ultimately partners with, which was Orthopedics Illinois, and discussions with others like Somerset and Mike McCaslin. And this is the headlines. These are the headlines that came out after we stayed with this and went alone first. And this really, in my mind, is not a knock on private equity, because I actually think most of us believe there are incredible strengths with private equity. We just felt that we could leverage our abilities at that time to create more value, take a hard look at ourselves, taking what we learned in these private equity discussions and doing some of this ourselves was the lesson we learned, while we can stand by and watch what's happening in the market. And that's kind of where we sit today. So we initiated this in 2019 and we consummated it and went live in January of 2023. And the new entity is called Ortho Midwest. And the two units, the business units, are Midwest Orthopedics at Rush and Ortho Illinois. And both of us are doing business as a division of Ortho Midwest. So the ultimate is that we aggregate, we find ways to integrate, consolidate. It's not a consolidation, but it's an aggregation where we function on one tax ID. And ultimately, we think this maintains the private practice preservation and allows us to create real value. So what's an aggregation? So aggregation enables physician practices to come together in a clinically and fiscally compliant manner under one tax ID to develop further scale and leverage while remaining independent as a physician-owned and managed group practice, while each one continues to operate independently as its own separate division. So it enables us to transition pretty much at our own pace to create a fully integrated administrative model through an MSO. It allows us to consider consolidation of overlapping and redundant services, and it allows us to invest additional resources into MSO activities and to enhancing ancillaries and service line enhancement overall. So we would argue that the aggregation can mirror PE without taking money off the table, without reducing risk, but it can mirror it in terms of the model that they would come in to create and help us create without the formalization of a new business entity at this time. There's a lot of goals. There's preservation. These are the same goals, I think, that you would look at for PE and even an ESOP. There's preservation, there's positioning, there's prominence, right? So from a preservation, I would think of these mostly as defensive positions. So as a bigger entity, we believe we can stave off payer fee schedule reductions, tiered network steerages, and even plans that were to exclude us. It gives us a better seat at the table for collaboration versus a, hey, just take it or leave it, which is what we've been living with, for example, from Blue Cross Blue Shield. Every year we get a contract, sign the dotted line, there's no negotiation. We think this will enhance our purchasing power to stabilize or reduce our overhead, maybe volume discounts, and actuaries actually favor much larger entities when we're dealing with pricing coverage policy. So we think we'll have a bigger voice, a more solid voice, and a more educated voice by growing and aggregating. Positioning. It allows ancillary service expansion through collaboration as a group practice now. We have the ability to do things together, for example, with DME and physical therapy. We plan and will develop a world-class MSO, and we do still, like Don pointed out, have to look into monetization opportunities. Doing this doesn't, by default, create monetization opportunities. It may increase dividends, it may reduce expenses and secondarily increase dividends, but in and of itself, it's not a monetization opportunity. It also allows us to have non-clinical joint venture collaboration. And if prominence matters, if ego matters, there's some other things that I think become very visible along the way. But as I mentioned, the goal of the aggregation is not a monetization event, right? When it's complete, it positions us, the clinical entity and the MSO, to adapt and maybe take advantage of market changes. So these 5 points are the things that become possible after the aggregation. So for us, the timing wasn't right for PE and probably wasn't right for the ESOP. But if the PE model now becomes the preferred path, we believe we'll be better positioned to maximize the valuation and negotiate a favorable deal structure. As medical ESOPs become a more efficient monetization tool, and I think you should really look forward to hearing this discussion on ESOPs, the infrastructure will be in place to execute that strategy. If we were interested in minority capital transactions that Nick alluded to, they like to deal with entities that can manage and monitor their investment in a very professional manner. We think we're better suited now to do that. We think we're more suited to deal with healthcare system alignment. We think we can go to other hospital healthcare systems and create true partnerships that we couldn't do before. And self-monetization becomes an option due to our size and our infrastructure. So it was appealing because we can maintain our individual unit brand. We can unwind it. And that was really critical. The one thing that PE, we really had a hard time understanding. The one thing we had a hard time understanding with the ESOP is what if we have to, in the unfortunate event, divorce ourselves from one another, what will life look like? And that's possible. But the flip side is our group was having trouble adding 1 or 2 guys, for example, in a specific section. We had immediate practice growth. We added 25 to 30 physicians, basically an almost equally sized group overnight that would have been impossible to do if we did this one by one organically. So from the ego perspective, the competition perspective, it was something we could get done where we otherwise were basically paralyzed. We have already seen immediate upside and efficiencies, and it's allowed us to do something productive as these other opportunities, PE and ESOP, better declare themselves. So I'm not going to go into great detail. I'm just going to show you the schematic, and you can take a picture or other, but essentially it involves Class A, Class B, and Class C shares. And Class A is basically, if you will, the MSO. That's the new entity, this so-called Ortho Midwest, right? The Class B shares are the individual units. So I'm Midwest Orthopedics at Rush. They're Orthopedics Illinois, right? Ortho Illinois. Those are the Class B units, that's self-governance. They are separate independent entities. And then anything we can do collaboratively falls into the Class C. So that could be growth into a hospital system. That could be ancillaries. That could be more physical therapy. That could be any unification that we choose to do collaboratively together. And there's essentially 4 major buckets of legal documents. We had to create a new operating agreement. We have an unwind agreement. We have a professional service agreement, and we have a care center agreement. The care center is basically individual business units. Currently, we only have 2, but we're looking to add additional care centers along the way. And then we have our organizational chart. And what sits on top is this new entity, the MSO, if you will, at Ortho Midwest. We have a board of managers, and then each business entity has their own representation going down to the board level. And then there's lots of things that we now can do together. Strategic planning, as Nick pointed out, none of this works unless you have a strategic plan. This created a foundation for us to sit down and say, what is our strategy going to be? It allows us to have a payer and quality strategy, purchasing and vendor relationships, benefit coverages and policies, and organizational compliance. All of these things can actually fall within the MSO. So what can we do with the MSO? Basically, that provides the non-clinical services to our providers. And it basically creates an external entity. It offers the opportunity to have a capital partner, and it offers the opportunity to have eligibility for qualified business income tax benefits. So you have all of these things in your practices right now, sort of that management does today, all of these things. And what the MSO allowed us to do is basically offload some of those, right? From an efficiency point of view and an expertise point of view, we're now able to separate things that happen within the business unit and things that can now happen in the MSO. Frankly, all the things that would have probably happened with private equity. And then it allows us to do a black box analysis, which is essentially a compliant legal way to look at a payer mix to say, what are the potential increases by going to a new tax ID and what are the potential decreases? And this is probably one of the most exciting areas. And if you speak with Melvin, they will tell you they have rarely seen any issues of reduced reimbursement with their black box conclusions and ultimate aggregation. So inclusion, where are we now? We're still a private, independent, multi-specialty group. We have a new tax ID number. We have at MOR 30 equity partners, but if you look, we're more than twice the size now in aggregation. But we've grown along the way at MOR. We're now not just 35 providers, but we're 52 physicians. We're not just 40 advanced practitioners, we're 50. We went from 500 to 900 employees. We now have 7 clinics, 17 physical therapy clinics, and 8 ASCs from 5. We now have this new MSO housing the business of our practice, and we have potential for growth opportunities. And these are opportunities, but they also pose the biggest challenges. That's value-based care, clinically integrated network, practice acquisition, further hospital relationships, service line initiatives, all of these things that could provide for growth. So there's lots of strength of this model that you see here. We are sort of thumbs up, and I think we left the gates, I think, with some initial successes and wins, but there's several potential weaknesses, and we realize we're going to have hiccups along the way. And in the end, as I mentioned to you, there really is no opportunity at this point unless we create it for a monetization event, and that can come vis-a-vis an ESOP, private equity transaction, or capital partners. So what are our current challenges, sort of wearing on our sleeves? Yeah, we do have challenges. We have challenges now. We're essentially, I don't want to say maxed out, but we do have challenges with access to capital at this point. We have tremendous bandwidth challenges. Now we've identified all of these growth opportunities, but we're dealing with limited bandwidth, and we don't really have the internal expertise currently in many of the areas that I think are growth opportunities. So just, it doesn't solve all the problems, but it creates lots of opportunity. But I think you have to maintain a lot of humility along the way. And maybe a year from now, I'll be able to share some of our further successes. So ultimately, with this MSO, we think that we'll be able to have a more important initiative to take on strategic capital partner relationships. Thank you very much.
Thanks, Brian. That was great. And then finally, you've heard this term ESOP. Many of you may not even know what an ESOP is, but it's a very unique tax efficient vehicle for a private company, in this case, a healthcare practice, to enjoy some liquidity from the value that they've created. So Mike, if you don't mind sharing with us some thoughts on how an ESOP can be helpful.
Yeah, absolutely. Let me get my slide up here. All right, can you see the slide?
Yep, we're good.
All right, great. So it's a lot of information. Unfortunately, I'm about to add some fuel to the fire for everyone. So bear with me as we get through this. CSG Partners are a boutique investment bank. We focus exclusively on ESOP transactions. ESOP is an employee stock ownership plan. Since we were founded in 2000, we've done over 350 transactions. We have a 30-member team across the US. We work across industries, but we do have specific verticals such as healthcare. Our healthcare experiences included medical practices. So in addition to orthopedics, we worked in radiology, ophthalmology, general and primary care practices. In addition to that, healthcare staffing, home health, all the like. So in terms of size, we work with companies in the range from less than $10 million in profit all the way up into hundreds of millions of dollars. So most medical practices fit quite well within that sweet spot. All right, so this is kind of positioned as an alternative, but it's really another consideration. Private equity over the last 5 to 6 years, longer for some firms such as Don's, have focused on healthcare for some time and have really increasingly acquiring healthcare companies, including medical practices. What this has done is set an extremely attractive valuations for medical practices in replacement of basically your traditional buy-sell agreements. To Don's chagrin, I'm sure there's a lot more generalist-focused funds, unlike his, that are entering the space. Don and his firm obviously have a healthcare focus, and so as you're looking for providers, that's something I would certainly second from Don's point. Private equity helps provide that liquidity path for physician partners. In addition, it also can ease the transition into a professionally managed practice. So for other practices that are looking for, you have entrepreneurial drive and you have the right management team, there's actually a second option, which is selling to an ESOP, or employee stock ownership plan. ESOPs pay fair market value for the stock that is sold. That's defined as what a financial buyer would be willing to pay. So what a private equity firm is willing to pay for the stock of a selling practice. The practice remains independent afterwards, post-transaction. The sale is structured for the benefit of the sellers, not necessarily a third-party buyer, whether it be private equity or a hospital system strategic buyer. And all of the equity that is sold remains in the hands of the existing shareholders of the practice through partners, rising partners, new partners, as well as the employees of the practice. It's also the most tax-efficient transaction that you can utilize. Selling partners have the opportunity to defer and ultimately eliminate the capital gains tax on a sale. And the practice post-transaction has the opportunity to actually become 100% tax-free of all federal taxes at the corporate level, as well as in most states, most state taxes. So ESOPs are not a new concept. They were actually created alongside IRAs and 401ks with the passage of ERISA back in 1974. Today, there's over 6,500 ESOP-owned businesses in the US. There's over 14 million participants in ESOPs, and those participants hold assets nearing $1.4 trillion. So it's not necessarily an unheard of concept, although it is relatively new in the way that we're utilizing it. So what is an ESOP? An employee stock ownership plan, from a textbook definition standpoint, is an ERISA authorized defined contribution plan that invests in your employer's securities. The plans are regulated by the Department of Labor and the IRS. The way that CSG and the way that we really think about it, though, is that it's a tax advantage leverage buyout of your own practice. So what do we mean by that? It means that you're essentially creating a known eligible buyer for the practice's stock in the form of an employee stock ownership trust, which we'll talk about in a moment. That trust will pay fair market value for the stock that's sold to it. And the financing for that stock, the cash that selling physicians receive, is borrowed using the company's own balance sheet. So just like when private equity acquires a medical practice or MSO, it leverages your balance sheet to finance a transaction for part of it. The rest comes through equity. We're basically using the same leveraged balance sheet to fund the ESOP transaction. It's tax efficient from two different areas. One is that from a corporate perspective, the MSO or practice can deduct the sale value. So if you sell your stock to an ESOP for $100, you'll receive $100 worth of tax deductions that can be utilized over time. Once an ESOP owns 100% of the outstanding stock in an MSO or practice, it will become 100% tax-free of federal and most state income taxes without the need of any additional deductions. From the selling partner's perspective, it provides an opportunity through a specific section in the tax code specific to ESOPs. When you sell stock to an ESOP, you can elect section 1042 of the code. That allows you to defer and ultimately eliminate the capital gains tax on the sale. The board of directors that's in place today continues to operate the business going forward. You don't have a third-party buyer governing the business or the practice going forward. And the sellers can maintain upside for a quote-unquote second bite through retained stock. You can sell minority to an ESOP, anywhere 30% or above. You can sell majority. If you sell a majority sale, we create and carve out something called warrants or synthetic equity that's akin to stock options that allows physicians and partners to maintain upside in the practice or MSO going forward while that practice is growing in a tax-free manner. Finally, and the reason this is all possible is because it creates an extremely unique retirement benefit for employees. Especially in the healthcare space, this is a space that has increasingly more difficulty, especially since 2020, recruiting and retaining talent, both at the mid-level as well as the entry-level staffing needs. And so this provides a unique option to differentiate yourself in your marketplace. So, an ESOP is an extremely flexible structure. Every single transaction is effectuated for differing reasons. One of, I'm pulling 3 examples here of practices we've helped in the past move to ESOPs. The first, they explored an ESOP because they're focused on legacy and patient care. They had briefly considered a sale to not private equity, but to a local hospital system to unlock cash and liquidity for physician partners. It led to a series of soul searching, and the practice ultimately decided, they had a long-standing focus on value-based care and a very strong commitment to the region that it served. In the state that it operated a niche section of a state, about half of the state down in the southeast. And the partners ultimately were unwilling to give up control to that third-party buyer, called off the M&A process, and completed an ESOP transaction to create that same liquidity. A second practice that we worked with, and this kind of goes to Dr. Verma's point and everyone's focus on growth, was on creating independent growth. So this was a single state practice. They had a very strong hold on the market in their specialty. They wanted to create liquidity for the more senior shareholders in the partnership. But at the same time, they had a management team and younger partners that were very much focused on growth and not liquidity. And so ultimately what we did is sold the senior shareholders' stock to the ESOP to create that liquidity. And then the young partners in the management team were able to continue to grow the practice, utilizing the tax savings, because we structured in a way that it became tax-free in perpetuity. So since that period of time, this is about 5 years ago, the practice has now grown from that single state to in over 6 states across the country through a combination of both organic investment themselves, as well as acquisition of smaller practices, kind of those add-on acquisitions over time. The third practice that we've helped, and again, for a differing reason, explored an ESOP, is because they were focusing on retaining physicians. They had a traditional buy-in, buyout structure that were extremely productive, even in their specialty. And they essentially changed the buyout structure to retain those physicians. Instead of a traditional buy-sell agreement, they set up a buyout value that was a multiple of EBITDA, or the profits of the practice. And it basically became very unsustainable. While it solved part of the issue for the more senior partners, they were unable to attract any new partners because the amount of a buy-in for a new partner went upwards of $2 million, and over time grew to over $5 million. You're trying to attract a new partner, you can say, hey, you're going to buy in, it's valuable practice, we have great compensation, we have great ASCs, but asking someone out of medical school to pull out $5 million in a personal loan is a pretty tough ask. So we ultimately utilized an ESOP tool to create numerous on and off ramps for physicians as they mature in their practice. They're able to sell. It also created affordable buy-in options for new partners. So again, going to the point that there are many different ways that ESOP can be used, and it's on a case-by-case basis, the best way to be used for your objectives. One of the things that we've kind of Dr. Cole had mentioned was creating an MSO, or management service organization. That's required in any sort of private equity or ESOP sale in states that have corporate practice and medicine doctrine. Some have carve-outs for ESOPs, but most do not. That basically, corporate practice and medicine doctrine prohibits non-physician ownership of medical practices. So separating out your practice into 2 businesses. The way I like to think about it is, today you have a practice that has 2 businesses within it. One is focused on treatment of patients, providing clinical care, making decisions for patients and recommendations. And the second is all of the support services for those physicians and clinical services. So your billing, your invoicing, collecting, managing your real estate, your leases, equipment management, and all of the like there. So basically, in any sort of ESOP or PE sale in a corporate practice and medicine state, you have to separate those 2 businesses out. The medical practice in an ESOP sale remains 100% ESOP, 100% physician owned. The governance does not change. The ESOP and MSO have no relationship in terms of influencing the practice going forward. and the MSO is what is sold to the ESOP. Similar to what Don had mentioned, you have to create retained earnings, just like in private equity, you have to create retained earnings that can be leveraged and sold to the ESOP. If you have a practice or an MSO that makes zero profit, there's really no value to be sold. So in exchange for creating that relationship of providing non-clinical services to the practice, the practice will pay fees over to the MSO from retained earnings generated by reducing physicians' compensation, usually in the range of somewhere between 20 to 30%. So we put this together just looking from a selling physician standpoint, the powers of an ESOP, especially from a tax perspective. We use a very simple example here. We assume we have an MSO or practice with $10 million of EBITDA. Again, EBITDA is essentially just your profit. You sell it at a 10 times multiple to keep math easy. You have then an MSO worth $100 million. If you sell to a third party, whether it's private equity, you'll have some sort of equity rollover that allows you to get that second bite at the apple when the private equity ultimately seeks to sell after their holding period of 5-6 years. But you will sell, basically, let's assume here, 75% of the equity today. That'll give you $75 million under our example. You do have to pay capital gains tax. So in national average is about 25%. You'll pay $25 million in capital gains tax. That leaves $50 million on the first bite of the apple in after-tax proceeds for the selling physicians. The other 25%, if the investment goes well, will ultimately add on top of that. Again, an ESOP can be structured in countless different ways, minority, majority, many different structures. Here, to keep apples to apples, let's assume we sell 75% of the same practice or MSO to an ESOP. So again, 75% is $75 million. Because you can defer and eliminate capital gains tax under an ESOP structure, that gets $75 million of after-tax proceeds in the physician's pockets over time. And the remaining 25% is exchanged of equity, unsold equity is exchanged for warrants. That allows the practice now or MSO now to be 100% tax-free in the structure provided, but carves out that warrants, exchange 25% for about 40% of warrants. That allows you to buy 40% of the fully diluted value of the MSO in a future date at a predetermined price. And it allows you to hold the upside from a partner perspective in the tax-free entity. So it becomes extremely powerful for that theoretical second bite of the apple. Now, I want to point out, this is not a loophole, right? This is something that's been authorized by Congress since 1974. There's bipartisan support. Since 1974, there's been iterative legislative changes that make ESOPs even more tax favorable over time. There was something passed last year that created more tax benefits, and there's many more working their way through Congress. It's been explicitly authorized because it provides such an powerful benefit for employees. And it creates, the theory is it limits or lowers inequality within the US, creates more competition by having less consolidation. Ultimately, participants in ESOP-owned businesses have over a 50% longer tenure within the practice or business. That's obviously very important within healthcare, has higher productivity, and obviously have an extremely large retirement benefit over time. Now, it's important to note, when you sell to an ESOP, all that stock that you sell does not go to employees on day one. It's sold into a trust, the beneficiaries of which are all of your eligible employees that vest over time. Usually that stock is allocated over 20 to 50 years. So it's a long period where that stock is allocated. Employees today don't just get dropped a bunch of stock and can leave and make a lot of money off of it. It's based off of years of service and staying with the business over a long period of time, which incentivizes, obviously, those higher tenures of employee-owned businesses. How are ESOPs financed? Obviously, your employees are not coming out of pocket to buy your stock. It's a free retirement benefit for your employees in exchange for their service. We use, as your advisor or investment bank, we help raise the capital to finance the initial transaction. It is all debt financed. You're leveraging your balance sheet just like any sort of private equity third-party sale. We go to the same capital providers. Lowest cost of capital is obviously commercial banks, and that'll be some SOFR plus a margin. As Dr. Cole had alluded to, there's mezzanine or private credit options that are higher cost of capital. And then any difference between what you can pay or raise on the private markets through debt and what is ultimately paid or the value negotiated with a third-party trustee is seller debt. It's essentially an IOU to the selling partners that's paid over time with the tax advantage cash flow of the MSO. You basically, as a selling partner, step in the bank's place. You earn a high interest rate or return on that IOU until it's repaid. It's usually repaid within 2 to 4 years at most. So to illustrate the corporate tax benefits here, we go back to our example where you have an MSO that makes $10 million of pre-tax income. Usually over a 5-year period, whether it's owned by a third-party private equity or just status quo as you operate today, over that 5 years, that $10 million of profit would ultimately lead to about $23 million in tax and tax distributions. And ESOP, because it can operate virtually tax-free, can nearly or more than triple that cash flow over that same period of time. All of that tax savings is used to quickly, rapidly delever the balance sheet, pay down the transaction financing, and ultimately provide, even after the debts are paid, provides all of the cash flow you need for growth. So, going back to that example that grew into 6 different states, they basically became tax-free, used all that cash flow to acquire smaller practices and invest into new providers and places within their target states. And so you can use it for strategic investments as they did. You can use it for operational investments, self-funding MRIs, X-rays, building out new ASCs, urgent cares, whatever your practice wants to do in terms of growth, it provides the opportunity to do so. The third option is you can simply use it as a financial investment tool, right? You can diversify your balance sheet. It provides a buffer or war chest in case of an economic downturn, a bad change in payer mix, and gives you the financial assets essentially to compete in your marketplace against not-for-profit hospitals as well as competing practices. Now, we've touched on this a couple of times tonight, but it's important to look at this as a solution for all the different physicians within a practice. Every practice, as you know, has a number of different constituencies of physicians based off of where they are in their careers. So for senior partners, let's say those that are looking toward retirement within 5 or so years, any sort of PE sale, ESOP sale, liquidity event is more or less a no-brainer, right? You're going to get paid 10 plus times multiple for your stock, and you can defer or turn that ordinary income into capital gains in a private equity sale. In an ESOP sale, you can make it tax-free. It's more or less a no-brainer, but you're able to leave with the ESOP an independent practice and ensure your legacy is secured. What's more difficult is understanding how it works for rising partners and those employed physicians or partners that are not yet brought into the fold, future partners. What you're able to do is you're able to hand over a practice that has enhanced cash flow. They also get a lump sum or upfront payment for their value. But more importantly, because we do structure this for the selling practices objectives, you carve out a large part of that synthetic equity. So in the example, the 75% sale example, you had 40% of the value on a fully diluted basis in the MSO that can be transferred to rising and future partners. And that basically means if you take a step back, you think about it, if you're a rising partner, you're just starting your partnership track and career, you receive a big lump sum payment. Sure, you can turn it from ordinary income into capital gains, and capital gains deferred and eliminated through the ESOP. But at some point, if you did nothing, and you would reach a crossover point where you'd be better off having not sold, right? You're ultimately going to reach that point. With the ESOP, what we're able to do is actually eliminate that crossover point by giving synthetic equity or warrants in a tax-free entity. So eventually where that crossover point would have been in year 15, 16, the warrant values continue to grow and create a large asset that they can ultimately liquidate, put back to the practice. When they retire, the practice will buy it using the practice's or MSO's tax savings. And then finally, I know this is a lot of information, but finally, it's important to note that an ESOP is not a necessarily always permanent solution. If you sell to an ESOP this year and in 2 years, 3 years, Don comes to you with an offer that you can't refuse, you can always sell to private equity. You can always sell to a strategic buyer. This does not preclude you from doing that. It does mean that when you sell, some of the proceeds will go to the employees and the rest to the partners. But within ESOP, it also is a natural recurring cycle. So within ESOP, when your employees reach retirement age, they come back to the practice or MSO and say, hey, I've reached 65, my retirement age, I want to cash in my ESOP stock. The MSO uses its tax savings to buy that stock back. And naturally, over time, the percentage of the pie that the ESOP owns shrinks, and the percentage of the pie that the partners own through warrants grows. And so there comes a point in time where many ESOP-owned businesses, medical practices, and others will ultimately say, look, the ESOP's been great, but it's shrinking in size. We should just buy it out all at once, lump sum. So you can re-leverage the balance sheet. You can use tax savings that have accumulated on the balance sheet to buy out the ESOP in a negotiated buyback from the ESOP trustee. And that ultimately provides you an opportunity where the rising and future partners, the youngest partners in the cycle that we had just spoken about, have an opportunity to own 100% of the MSO or ESOP again. That's an opportunity that when you sell to a strategic or financial buyer outside of an ESOP is very rarely the case unless something bad happens with the investment and it's not going as planned. So it provides that flexibility in the future. You're not making a decision that is irreversible for future partners and generations. That was a lot of information very quickly. Feel free to reach out with any questions, points of clarification. We have a QR code here that will take you to kind of the healthcare section of our site for more resources if you would like to peruse at your leisure. Otherwise, I'll hand it back over to you, Dr. Verma.
Mike, that was awesome. Thanks so much for the overview and the education on the ESOP. For us, it was a novel concept, but one that I think can be really powerful when executed appropriately. So I want to be respectful of all of our panelists' times. We were supposed to end at 8:30 here. Don, one question that came up was, we didn't have much time to talk about this, but can you just quickly touch on the second bite concept? Have we seen any in orthopedics yet? And how does that look based on your historical experience with dermatology, ophthalmology, other fields where it's a little bit more mature?
Yeah, actually, Brian, it follows this even more than I do in terms of second bites. And although, my healthcare team would obviously know the details of that current market, we haven't seen a major second bite transaction in orthopedics yet. I do believe they're coming. A lot of the transactions that Brian kind of highlighted are still early stage. The 3 to 7 years is very short on the front end. And I would almost say it's more like 5 to 10 is our time frame. And so I don't think we've seen it yet, Nick. We have seen larger physician practice deals, though, in dermatology, in primary care, that indicate they will be available. I mean, I have no doubt in my mind that if you execute on a first bite platform, add-on acquisitions, build the value we all three presenters talked about in terms of internal growth and ancillaries, that transaction out there, to a larger investor, another private equity firm, hospital system, strategic buyer, I think it's out there. In orthopedics, it hasn't happened yet, but it all comes down to execution. I mean, like you said in your presentation, it can work or not work. it comes down to execution to get to that second bite. The first bite, I think, is valuable to the existing partners. I think it has a monetary value today. Getting to that second bite, though, for the young partners is going to be very, very important. And it's a matter of execution. But I think that we have enough evidence in physician practices that as long as you're successful with the operational and growth plan, there will be a transaction. Will it be at 10 times EBITDA or 15 times EBITDA? You know, how valuable it will be determined based on the market at the time. But yeah, I'm not that worried about that part of the model. I'm more worried about from the first bite to the second bite, the execution of the plan.
And the other thing I just wanted to ask both you and Mike is, you know, we've obviously seen a big change in the financial environment in the last 12 months, interest rates being a big part of that. For those who have not done something like this, have we missed the boat? I mean, are the multiples way down? How has it affected the ability to execute on either one of these transactions? Do you want to start, Mike?
Yeah, I would say, I mean, obviously interest rates increasing reduces valuations across the board. But frankly, we're negotiating transactions day in, day out. We have not seen a huge meaningful change. It does mean that the ESOP trustee and the lenders in transactions are taking a much closer look at practices. So some of the, I think Don had mentioned, you know, some of the transactions that were done previously probably aren't going to be done the same way. You know, there's, again, to Don's point, there's a lot of generalist firms out there that are trying to kind of eat into the healthcare space and probably overlooked some things because they thought everything in medical practices or healthcare makes sense. So you have a lot more diligence being done. And as far as raising the capital or the debt, again, it's the same thing, more diligence. And especially with the ESOP case, when you have, you know, historically saving 40% of your after-tax cash flow from tax savings, you have coverage ratios that are double what they would be in a taxable business. The lenders are very comfortable lending because they see that huge cash flow cushion in comparison to a taxable business. So it's a unique aspect that we've been sheltered from a lot of the turmoil.
Don, what does that look like from a PE perspective?
I'd say, I mean, you know, Mike's kind of structure in business is a little different. I would say the increase in 0% rates to 5% on, you know, the overnight rates with the Federal Reserve, meaning that buyout debt or growth equity debt has gone from effectively 5% cost to 10%, has had a pretty significant damper on M&A activity. Has nothing to do with physician practice management or physician services businesses as an attractive business. It just has to do with the cost of financing for every kind of deal. So you've seen a greater than 50% reduction in private equity initial transactions in the last year. And that would just be the same for an orthopedics physician services company as it would be for a retailer or for a manufacturing business. And that does mean, you know, I had the example in there at 12 times EBITDA. I would say, you know, during the frothy parts of the equity markets and the 0% rates, 12 was almost the low end or the middle to low end. And you could see transactions going off at higher multiples. I have to say that in today's world, it's probably more in that the cost of financing is so much higher that equity values are probably more in the 10 to 12 times EBITDA range for physicians. So I wouldn't say you missed the boat, but, you know, was there a moment in time a year ago, 2 years ago, Nick, where equity valuations were higher across the board, public and private? Sure. I mean, that they are. I still think at 10 to 12 times, there's tremendous value in the opportunity of having a capital partner. And, you know, hopefully these interest rates aren't around forever.
Hey,
yeah,
Don,
just simple
Don,
math.
Don, quick question. It was said to me by someone that every incremental debt that you take has an effect on the terms of the debt that you had before for your deal structure. So as you bolt on new practices through acquisition and get bigger, do the new terms have an impact on the previous terms and the debt that you already have?
They do in this market right now, Brian. And I'm not sure what the questioner is referring to, but for certain, the terms and the amount of debt, not just the cost, were very advantageous, during that 0% rate and during that equity value run-up rate, during the entire period pre the beginning of inflation, the beginning of interest rates rising. The terms were very generous to borrowers, meaning, and ultimately that flows through to the value to physicians when they sell, or any owner when they sell. And the amount of debt available was higher as a multiple of earnings than it is today. So the problem that some existing borrowers / consolidators have is they have very advantageous debt that exists in terms of both rate and terms and amount. And when you now say, oh, I need to go and buy more practices and I need to raise more debt, that usually involves refinancing your existing debt.
Right.
And that means that you get stuck with the new, not as good terms on your old debt as well as your new debt. And that is a major, to use one of your buzzwords, headwind for existing practice consolidation plays. They were put together on the assumption that debt looks this way, but to actually get to where they want to go, they have to take on more debt. And the current market means that that new debt and your old debt is not as attractive. So that may be what they're referring to.
Yeah, that just seems to me that would have a dramatic stifling effect going forward, because you depend on growth, practice acquisition to go to the second bite. And all your assumptions were based on the previous debt. So,
and I guarantee you, I haven't looked at this, but I guarantee you that physician practice acquisitions by private equity backed companies are running at a lower rate right now than they were a year and a half ago.
Yeah,
that's just true in everything.
Yeah.
But it is an issue for existing consolidators. The model that they assume they were going to be executed under isn't quite as good, and that speaks to the entire kind of conversation we've been having here, which is you have to have a great partner that's going to be with you for 5 or 10 years. Reimbursement could change, interest rates could change, inflation could change, and you have to have a really, really strong sort of partnership, not just economically, but governance and vision-wise with your capital partner.
Brian, just one last question, then we'll let everyone enjoy their evening. One of the things that I think it's underemphasized is the expertise that it takes to do this, whether you're doing it alone or with a strategic partner. And Don emphasized the importance of picking the right person who's not just bringing the money to the table, but is actually going to help execute on the plan. And I think that's been a hitching point for us as a private group. Can you talk about, your thoughts on how to get that expertise and if it's available?
Yeah, I mean, I think that's what we're starting to see now, is that we have so much opportunity ahead of us, but we're recognized that we don't have the organic expertise in these areas because they're new ventures. And even if we have some of the expertise, we only have so much bandwidth. So it leads me to think about how any strategic partner we have, I would look to those services and those strengths, because if we're going to, now we've got anyone who has a foundation, you're only as good as the foundation to the point where you got to execute. If you don't execute, it doesn't matter what you have. So that seems to be a recurring theme. So what we've leaned on are people. What we're going to do is talk to people who have done certain transactions and done these things that we would potentially mirror or learn from their mistakes or their successes. There are consulting firms that do these types of things, and ask a lot of questions. Because frankly, I don't think any single private equity firm comes in with all of that expertise. I don't think any single individual has all that expertise. And it's so dynamic now. People are all talking about value-based care and clinic integrated networks and neural networks and direct employer. But the reality is so little has happened in the orthopedic space that we're all kind of doing this together. So I don't think anyone has a lock on the knowledge. So I think everyone has to have enough humility to say, look, I don't really understand this. I've never done it. I need to get some help in getting this done. So you don't spend a whole lot of money and not have the outcome that you're looking for.
And
I think I was going to say, Don, I think one of the keys here is with either of these structures and including our structure, Brian, is this is not where you just drop the keys off, take your cash and walk away. I mean, this really depends on the appropriate governance and execution on the strategic plan long term. I think one of the things that the two structures, ESOP and PE, bring to the table is a modernization of the governance structure, which means that you go to a corporate governance structure where you're looking for what's best for the growth of the practice, not necessarily what's best trying to marry 30 independent individuals into a decision-making process. And the second thing I think is particularly in the PE world is you probably get access to people that have experience in developing value in a company, which is not really what's been seen in the healthcare space traditionally.
Don, do you have a response to that? I know you were thinking about something.
No, I was just going to say, I mean, if a private equity firm tells you they're going to bring all this expertise that you're talking about to the table, I would be very skeptical. I think the expertise it's one piece that a private equity firm can bring, which is going to be largely on this value creation, you know, how to look at acquisitions, how important is organic growth, what is the return on my investment when I make organic growth decisions. I think those are the things that private equity is really going to be able to bring to the table. But it's marrying up that with great, you know, executives, a great CEO, a great acquisitions person, a great CFO at the company, and helping the physicians create that management team, combine it with the financial expertise that the private equity firm brings in value creation, and then combine that with the entrepreneurial drive of the physicians to improve care, make it more efficient, make it better, be able to do value-based care in the future if that's what you get. And bringing all those three things together under a governance structure that everyone has confidence in and allows you to make reasonably quick decisions, as opposed to trying to do all these things underneath a 20 partner model where, you know, everyone has to kind of sign off, or you have to have votes all the time and stuff like that. Yeah. Getting trust in that group from the physicians that they're going to look out for the physicians for their experience as a practitioner and for their financial well-being is very important.
So, you know, Don made the comment before we started that we probably could spend 3+ hours and a whole day on this topic and still barely scratch the surface, but I want to be respectful of your time. Thanks very much, Mike, Brian, and Don, for spending a couple hours with us. Your time is very valuable, and we truly appreciate the education. Thanks to ASCS and John for helping to shepherd this through. It will be available online, so hopefully we'll get a lot of people to get some education out of this. And I know the contact information for both Mike and Don's groups are available if this is something that's of interest to you. Thanks, and have a great night.
Thanks, everybody.
Thanks very much, everyone. Take care.